Welcome to the InterMarket Analysis Update. This is being prepared June 5th, and this will cover the analysis for Monday, June 6th. And these videos are prepared on a weekly basis or on an as-needed basis. But since nothing changed since the last time this video was posted, I went ahead and waited a week. Let's go through first and look at the current valuation of the S&P 500. This is taking the trailing 12 months, looking back. Now, I realize that the market looks forward using forward PE ratios, but this can also be very useful to us by looking back over published numbers, and we can get an idea, is the market expensive, fairly valued, or considered cheap? Right now, if you look up on the top, you can see that we're well above this red line. That means that we're above a PE ratio of 20. So the market is currently considered expensive when looking backwards. Now, when we're looking forward, it's not necessarily expensive. It's more fairly priced right now. But I don't cover that in this particular video. What I have down below is just the difference between the closing price of the S&P 500 on a monthly chart and then the distance to the red line. And we really became very overvalued back in 2021. Well, we've been coming down ever since. Sometimes this can help by the market coming down. This can also be helped by these levels for PE actually going up. When we saw a decline further than where we're at right now, we actually saw this line come down below the current value for the PE of 20. Here's another look just going back historically to show you what the valuations were during major events in the market, the housing crisis, and then here's the COVID plunge right here, and this is how we've performed since that time. Now, let's go in and look at some intermarket analysis. First, we look at the Pure Growth Index. These are stocks that really focus on capital gains and really grow. Well, they had been performing well up until the beginning of 2022, and we really saw them go into a downtrend, and this red line here is a 200-day moving average. The blue line is a 50-period moving average, and we are now in a downtrend as far as growth. When we look at value, we've been having some trouble too, but we're still in a basic overall uptrend. So value has been performing better than growth. And now we look at this on a relational basis. This just shows growth against value, how growth has been going down. The bottom chart is value with growth, and I have a number of charts. The reason for that is we can look at a lot of different indexes, different ETFs, and sometimes that gives us a little bit different perspective. This is the Pure Growth Index against the Pure Value Index, and for a long time, the Growth Index was outperforming, then it really shot up. We had a bit of trouble in 2021, came back up, and for pretty much all of 2022, growth has been underperforming. Now, this next chart is an inverse of that same chart. How value had been underperforming, did fairly well for a time in 2021, came back down, and now for 2022, value has been outperforming growth. Here's another look using the growth ETF against the value ETF. Shows how growth had been doing quite well, but lately has been really declining. Here's the inverse of that, showing how value had underperformed, but in 2022, value has really been outperforming. Another look is a growth index against a value index and taking a ratio, and I tried to put some annotations on this chart that just show that growth has been really underperforming value. Let's look at some index ratios. First, I look at the CRB index. This helps us to determine inflation overall. This is a daily chart, and we've been in a really strong uptrend ever since hitting the COVID lows. When we take a ratio of commodities, or the CRB index, against the S&P 500, for a number of years, commodities underperformed stocks. Well, we started to see things get a little bit more powerful for commodities in 2021, and for 2022, they've been really outperforming. We also have an inverse, which just shows how the S&P had been doing better. It flattened out in 2020 after the whole COVID plunge and has really been underperforming in 2022. Looking at the NASDAQ 100, the 100 biggest stocks that make up the NASDAQ, and those are the big boys like the Microsoft, Apple, the four-letter stocks that are really big. Typically, in a real uptrend, you'll see the NASDAQ 100 outperform the S&P. Well, and it did that for a while, but going into 2022, the NASDAQ 100 has really been underperforming the S&P 500. Looking at some other stocks, here's the S&P 100. Those are the 100 biggest stocks that make up the S&P 500 against the rest of the S&P 500. And the 100 biggest stocks have been underperforming, and they continue to do so. This is one that I'm really starting to look at because in the daily videos, I have a thing called the possible positive scenarios, and one of those involves small caps. And so I've been looking at how have small caps been performing in relation to the S&P 500. In a good, healthy environment, we'll want to see this in an uptrend because these are smaller stocks. They're not as big. They're not as old sometimes. They're not as established as other companies. And so investing in these tend to be considered more risky. Well, in a good, healthy environment, people will get tired of the blue chip stocks or the household names that everybody seems to invest in, and they'll go out looking for other stocks that are a little more adventurous. When small caps are performing well, that tends to really help the market. When small caps underperform, that really hurts the market, and they really underperformed for most of 2021. They've been bouncing around in 2022, but we're seeing a little bit of a breakout here. And sometimes we see small caps as a leading indicator for a short-term up move in the market. We see the small caps burst up, and then suddenly after that, within a few days usually, we see the S&P 500 go up as well. Not for a real lengthy move, but something that some investors like to capture. We've seen a little bit of a breakout right now. When the markets are going down, people like to get into low volatility stocks. It doesn't mean that those stocks won't go down, but typically they will go down less. They've been in an overall uptrend. This is just an ETF of a low volatility S&P group of stocks. Then when we take that and compare it to the SPY, where for periods of time, the low volatility stocks underperform. We ran into some trouble in 2018 and into 2019. The low volatility stocks did quite well. Then after the COVID plunge and the huge move up that we've seen, low volatility stocks really underperformed. But for 2022, they've been outperforming, even though they've seen some recent weakness. They're coming down to the 50-period moving average. Can it bounce off of that, or will it fall down below? Another thing that we follow is the Dow Jones Composite Average. And some people think that this is actually a better representation of the stock market as a whole than even the S&P 500, which is kind of where I stand, but I can see the logic behind that. It takes the 30 Dow stocks, it takes the transportation stocks, and it takes utility stocks and puts them together into one average. This has been having trouble lately. Even though the Dow's been holding up better than some of the other indexes, it's still been negative as well. And we're in an overall downtrend right now, and we're still below the moving averages. Another thing is Dow theory. And some people really adhere to this. Other people are like, what's that? Basically, the idea is that you look at the Dow itself and you look at the transports, and if they're going in the same direction and if they're confirming each other with highs and lows, that can give you some insight. In a good, healthy environment, they should confirm each other. Now, I also include utilities in here, and they tend to perform different. They've actually been doing quite well in 2022, seen a little bit of weakness lately, but we want to keep an eye on this just to see how these three are acting with each other. And then I also have a longer term chart, and sometimes we can pick out divergences here. You can see here we're going higher with the Dow, but we were actually going lower with the transports. A lot of people would go, no, can't do that, that's terrible, we're going to crash, everything's going to go down. Well, look at what happened after that. So sometimes these divergences don't pan out the way you think they will. And then, of course, on the bottom we have the utilities and how they've been performing. Looking at bonds versus stocks, first I show a total bond ETF. This is put out by Vanguard, and this takes all the different bonds with all the different maturities and puts them into one ETF based on price. So as these prices are going up, that means interest rates are going down. Well, for 2022, we've been seeing bond prices really decrease. That means interest rates have been really going up. Now, bonds have been trying to stage a bit of a bounce here. They came up to the 50-period moving average, but have since fallen down below that. Then we look on a little longer term basis, the stock to bond ratio. What would be better, getting into stocks or getting into bonds? Back in the late 90s, stocks really underperformed bonds when we hit the dot-com bust. Going up into the bust, stocks were really doing well. Then, after we finally bottomed and started going back up, stocks outperformed. Then we started to hit the financial crisis, and bonds would have been a better place to be compared to stocks. Then since then, we go back and forth, back and forth. Well, since the COVID plunge and when we finally started coming back up, even though stocks are having trouble, bonds have been having even more trouble, so they still continue to outperform on a price basis. When you're in stocks, that's considered to be risk on. When you're in bonds, that's considered to be risk off. And when we hit times of trouble, a lot of people will get out of the stock market and get into the bond market thinking that it's a safer place to be. We can also look at some shorter maturity bonds, the 7 to 10 year range, and how they really underperformed the S&P, and they still continue to do so even as we go in through 2021 into 2022. Bonds have really been having problems. Then we can also look at the Dow Jones Corporate Bond Index. The bonds that we were looking at so far, those are treasuries. Those are put out by the government. Companies also put out bonds as well, but they've been performing really poorly based on price. They've been in a downtrend. We can also look at the S&P against the 10-year yield. Now, interest rates are going up, so that means the treasury yield part of this has been going up. When you compare it to the S&P, it just shows that the S&P has been really underperforming the rise in interest rates. And there are ETFs that you can get into that just follow the yield. We also want to keep an eye on junk bonds. When interest rates are really low and people are seeking a return, they'll get into what are considered riskier bonds. Some people might call these high yield bonds. When it gets down to a certain rating level, they're considered to have junk status, and they can be riskier. They can also give you a better return, and sometimes people are chasing returns. But for most of 2022, we've seen junk bonds really underperform, and they're in a downtrend overall as stocks have been going down. And this is a ratio when we compare junk bonds with government bonds. And even though government bonds have been having trouble and junk bonds have been having trouble, looking over here on the right, it shows that junk bonds are still outperforming government bonds. Looking at the S&P against some different sectors, the energy sector has been the place to be in 2022, and it's really outperformed the S&P 500. The tech sector, this is all by itself. It's a huge part of the growth component of the stock market. And when this is in a nice uptrend, that's when we're seeing the market going higher. Well, we dropped below this moving average, and even though we're bouncing a bit, we are still in an overall downtrend. Another component that's not a sector but is an industry group are semiconductors. They play a big part of the tech sector. They've been in a downtrend for most of 2022 as well, and they're trying to come back. They're running into some resistance at the 50-period moving average. When we compare the tech sector against the rest of the S&P, the tech sector is really underperforming. Through 2019, after the whole COVID plunge, and really up into 2021, tech was the place to be. And these are the darling stocks, the Amazons, the Google, the Apple, and all those companies. Some other areas that we look at are growth ETFs against bonds. Okay, growth has been having trouble. Bonds have been having trouble. And right now, they're kind of about even with each other. Growth had been in a solid uptrend for quite a while, but it's been running into trouble in 2022. Bonds have been having trouble, and we're camped out right on the moving average right now. We can also look at the 10-year against tech, interest rates against the tech sector. Coming up before the COVID plunge, interest rates were going down in relation to the tech sector because the tech sector was doing so well. Well, in 2022, we're seeing just the opposite. Interest rates are really going up as the tech sector has been really struggling. This is just an inverse of that, showing how tech was going up, then it came down, and for 2022, it's been really underperforming when compared to interest rates. Another thing are staples, the things that you have to have no matter what's happening in the economy, against discretionary, the things that you would like to have. And the staples have been really outperforming, and that's what we see when the market's really having trouble. These are more defensive in nature. Where we can also compare discretionary against staples, and it just shows how the discretionary stocks, and they're the worst performing sector as of the time I record this, halfway through 2022. We can also look at the energy sector, which has been doing really well, compared to tech. But that wasn't the case for a long time. Energy was really underperforming. Now energy is really outperforming. We also keep an eye on gold against the S&P 500, and it's been in an overall uptrend. It's been performing better, but gold has been having some trouble lately, and we're coming down to the moving average. We're still in an uptrend overall, but it's been having some recent weakness. We also compare gold to the dollar. The dollar's just been screaming lately, but over the last week or so has really run into some trouble. Gold has been bouncing around its 200-day moving average. So overall, we're seeing gold just slightly outperforming right now against the dollar. Another thing that I like to post at least once a week, and I do this in the daily video as well, is InterMarket Analysis. This looks at all the different major markets out there. Now, I know I focus on the S&P, but how do I get my insight in the S&P? It's by looking at the other markets. And for 2022, this goes back to December 31st. Oil, of course, has been doing the best. That's been the place to be. In second place has been the dollar. Gold is up slightly year to date, where stocks and bonds have been really underperforming. Looking at some correlations, I only have one to show. When two things are moving together at the same time, they're both going up or they're both going down at the same time, they will have a correlation close to 1. When they're going in complete opposite directions of each other, their correlation will be as close to -1 as possible. You'll never get to a pure 1 or a pure -1. But what we've been seeing lately is a real strong correlation between the S&P and oil. It's giving us a very high reading. Now, there's been other times that that's happened, and that's helped the market to go higher. If we go up too much with oil, that might spook the market out. Other times when we've seen these climb more hand in hand with each other, we weren't at the high oil prices that we are right now. But lately, they've been having a real strong relationship, but it's backed off. Right before I recorded this, oil was up on Friday and stocks were down. So that's why we see the little downtick in this relationship. So let's look at all the things in the market that are positive or have uptrends right now. We have energy's positive, commodities are positive, gold, interest rates, and staples. And then we have a really long list of the negative things. All the different stock indexes, a lot of the bond indexes, stock sectors, some things like ARK, the ETF. Bitcoin is in a real solid downtrend right now, and it's just camped out at around 30,000. The Wilshire, Treasury, and corporate bond prices. Interest rates have been going up. Bond prices have been going down. So thank you very much. I hope you got some use out of this, and let me know if there are other relationships that you want me to explore within this intermarket analysis. There's a million different directions that you can go, so let me know if there's something that you would find interesting.